Wall Street investors are still in a relentless frenzy as stocks go higher and higher. They may have forgotten the risks of investing so much money in companies whose growth is not guaranteed, especially considering that economic conditions keep worsening by the day. They're truly believing the Fed will always come to the rescue. But the truth is that the days of Fed support are almost over. And when the music stops, this gigantic bubble will burst, and the entire financial world will be turned upside down once again. A number of renowned market veterans have been alerting about the growing risks, but so far, no one seems to be listening to their warnings. They've been telling us that even though most people believe this time is different, the current bull market has become unsustainable. Bulls can stand many things, but the slightest sign that a 2% interest rate hike is coming can scare them to the core. And what many investors may be failing to remember is that the Fed has announced that it will increase interest rates by the end of the year. Based on recent estimates, analysts forecast that the central bank can hike rates by 2.2% by December, and that figure goes up to 3.5% at the beginning of 2022. Such aggressive increases will come as a result of rampant inflation. Official data points that the inflation rate is at nearly 6%. But some economists argue that the true rate of inflation that people are seeing at the stores is ranging between 11 and 14%. As the holiday season approaches, inflation will soar higher. Unfortunately, this means that the Fed will have no other choice but to sharply raise interest rates before the economy overheats. And of course, this will trigger the inevitable stock market crash no one seems to be prepared for. For years, low interest rates have propped up equity markets worldwide. They make it more appealing to borrow money, to invest in stocks, and ultimately push up company valuations. However, today's valuations are far extended beyond norms by many measures. Although many want to believe that fundamentals do not matter, the market is cyclical, and that's a universal truth. This means that at some point valuations always come back to their norms, or as the hedge fund manager John Hussman explains, everything that goes up must go down. That's the law of equilibrium. Since the 2020 recession began, consumers started to earn almost nothing on their money in savings accounts, and that's why many have turned to equities looking for a better return. The speculative frenzy started when the Fed decided to suppress already low interest rates to near zero levels. That was when many new investors entered the bubble. Needless to say, when interest rates do rise, these investors won't stick around. Higher rates are also likely to create disruptions in the economy, with indebted companies struggling to meet higher interest payments. Now that alone could trigger another recession, but we don't even have to go that far. Since stocks are priced for perfection these days, the smallest slump could be bad news for the entire market. In essence, there's a wide range of different risks that could spark a stock market crash after an interest rate hike, but today's investors are choosing to ignore the looming dangers for the sake of higher future earnings. They've been buying the narrative that the Fed will do whatever it takes to avoid a financial collapse, and that it'll keep fueling stocks through its quantitative easing policies. History has shown us over and over again that there's only so much liquidity can do, and that narrative is coming to an end, and it will cause unprecedented chaos. If you don't believe us, Just take a look at the Fed's annual Financial Stability Report, in which central bank officials issued a very explicit warnings that the market is in a bubble and extremely elevated asset prices are risking to trigger a broader stock market crash. In a recent article, Bloomberg reported the highlights of the 85-page document published on the Fed's website moments after the market closed last week. The central bank warned that prices of risky assets keep rising, making them more susceptible to perilous crashes if the economy takes a turn for the worse. Adding that asset prices remain vulnerable to significant declines should investor risk sentiment deteriorate, progress on containing the virus disappoint, or the economy recovery stalls. This is proof that they already know what's coming next. They already know that there's no escape. The report also highlighted that near-term risks are higher than they've ever been. They've cited a number of threats to the financial stability of the United States, saying an increase in uncertainty over the course of the health crisis might pose risks to asset markets, financial institutions, and borrowers in the United States and globally, described the report. In addition, stresses in the real estate sector in China, caused in part by China's ongoing regulatory focus on leveraged institutions, as well as a sharp tightening of global financial conditions, especially in highly indebted market economies, could pose some risks to the U.S. financial system. If realized, the effects of near-term risks could be amplified through the financial vulnerabilities identified in this report. In short, this means that they know that the outlook isn't good in global and local markets, and that events happening all around the world are starting to combine and setting the stage for another financial disaster. The irony of all this is that the Fed's policies have not only caused, but also enabled the growth of this splendid stock market bubble that is now about to burst. They knew from the beginning that this was going to happen, but they kept bluntly lying to all of us. Now they're issuing the same warnings experts have been doing since day one, as if they couldn't realize before how big was the mess they've been creating. In fact, if we analyze previous bubbles, we can trace a suspicious pattern of behavior. Just take a look at the following excerpt from an article written by John Kenneth Galbraith right after the crash of 1929. The Federal Reserve was helpless only because it wanted to be. Clearly, the Federal Reserve was less interested in checking speculation than in detaching itself from responsibility from the speculation that was going on. And it will be observed that some anonymous draftsman achieved a wording that indicated that not the present level, but only a future growth in speculation would be viewed with alarm. Never before or since have so many become so wondrously, so effortlessly, and so quickly rich. Perhaps Messrs. Hoover and Mellon and the Federal Reserve were riding keeping their hands off. Perhaps it was worth being poor for a long time to be so rich for just a little while. It's always the same narrative that keeps being repeated on the loop. That's why we should know better this time. It's foolish to believe that the Fed will actually do anything to avert the next stock market crash. Just look at where we are again. This is the highest point to date of the most extreme speculative stock market bubble in the history of this country. Each and every bubble has been bigger than the last. There's essentially no getting out of stock or cash or bonds or any other security. At this point, every share of stock that's been issued is being held by someone. Every dollar of printed money created by the Fed is being held by someone. Every bond certificate issued by a borrower is being held by someone. This is the perfect recipe for a disaster. Recently, One of the most successful investors of Wall Street, the co-founder and chief investment strategist of GMO, Jeremy Grantham, is called out for the Fed for its utter irresponsibility. In a lengthy interview with Bloomberg, the strategist stressed that the Federal Reserve simply does not understand the risks of asset price bubbles and asset price collapses. Grantham highlighted that the Fed likes to play clueless and pretend they cannot see bursts coming, and we apparently believe them every time. We are willing to look through the crash of 2000, the housing crash. Really dangerous affair. They didn't do their duty. They didn't head it off. They didn't raise the limits for mortgages. They didn't warn anybody. They allowed it to happen. Yep, they did pretty well in the decline. They were pretty good at applying bandages and stimulus and support for the wounded. But they sure as hell should not have allowed that housing bubble to occur. They don't get it. They don't see the risks. They don't see them now. And so this time, we don't just have a housing bubble. We have a housing bubble, a stock market bubble, a commodity bubble, and an interest rate bubble. This is going to be the biggest write-down, Grantham explained. The investor argues that we're clearly deep into bubble territory right now. Bubbles are characterized typically at the end of a long bull market by a period where they accelerate and they start to rise at 2 or 3 times the average speed of the bull market, which they did last year, of course. There are a few people who would still argue that 2000 was higher, but most of the data suggests that this is the new American record for the highest priced stocks in history, he added. Now, in his view, the greatest sign that things have gone out of control is that today's speculation resembles a lot to what we've witnessed during previous bubbles. Then there's the most important thing of all, which is crazy behavior, he says. The kind of meme stock, high participation by individuals, enormous trading volume in penny stocks, enormous trading volume in options, huge margin levels, peak borrowing of all kinds, and the news is on the front page. This is all characteristic of the handful of great bubbles that we've had. In conclusion, he points that the biggest cage rattler of all is everything else you haven't thought about that could go wrong. And my guess is that's probably the cause, in the end, of most of the bubbles deflating. The mechanics of a bubble is that you have maximum borrowing, maximum enthusiasm, and then the following day you're still enthusiastic, but not quite as enthusiastic as yesterday. A week later, you're not quite as enthusiastic as last week and last month. And gradually the enthusiasm level drops off a bit. You have no more money to borrow, you're fully borrowed, and the buying pressure gradually slows down. And that's it. The next time we're pessimistic, we have more potential to write down asset prices than we have ever had in history anywhere. As we previously reported, nearly 54% of top-tier investors agree that a major stock market crash is coming by year's end. Those who are at the very top of the market have already started to reposition their portfolios to prepare for the financial catastrophe that lies ahead. In that segment of the market, investor sentiment is already at an all-time low. Even billionaire investors such as Michael Burry can see that this madness cannot last for longer. On Twitter, he summarized the bubbly nature of everything Wall Street, while Main Street suffers from soaring inflation. He says, more speculation than the 1920s, more overvaluation than the 1990s, more geopolitical and economic strife than the 1970s. He wrote about today's outlook. Michael Burry continues to say, people say I didn't warn last time. I did, but no one listened. So I warned this time, and still no one listens. But I will have proof I warned, he tweeted at the very beginning of the current bubble. For how much longer will we continue to ignore the red flags? Well, we've set that house of cards up again, but by now we have plenty of evidence that all of this will end in tears just like it did before. The Fed keeps pretending to the public that everything will normalize soon, but those who witnessed previous bubble bursts are telling us that the stage is set for another massive financial meltdown. It is clear that a brutal stock market crash is fast approaching. The final question is, who are you gonna believe this time?